Yeah, more bearish than bullish at the moment, and it's been a mixed message. Actually, if you look at some of the ETFs that have been making new 52-week highs and 52-week lows, it gives you a sense of just how split this market has been. The major index is now succumbing to some of that weakness underneath. But here you go. Here's new 52-week highs yesterday or this week, and two of them are short the market. So the EUM is short emerging markets, EPV short European stocks. That's a year-to-date change on the right there, up between 8 and 12%. But utilities is an interesting one. We've been remarking about how utilities have had this bid, even though bond yields are up. Seems to me it's about the fact that it's a safe sector. Dividends will grow over time and bond yields will not. Also, there's a little bit of an energy exposure play there. Oil and gas are up. Sometimes they get the benefit of rate increases. Rising inflation, that's a TIPS fund. So obviously that's one part of the bond market that has been appreciating. 52-week lows. There's a whole lot more of them. Here are four representative ones. The XHB housing sector peaked a while ago. If you listen to the stock market, the home builders are obviously on their lows. GXC is the Greater China Fund. We know what's going on there. But materials is another one. So these are sectors that should be cyclically geared. They should be giving you a good message of an economy running hot. But maybe they're really telling you that the market's on alert for the end of this cycle whenever it does come. So we have such major split between sectors. It's one of the reasons that index volatility has actually been lower than you might expect, given the number of 52-week lows, given the number of stocks 10% or more off their highs. It's because you have this push-pull of strong and weak stocks. Correlations among sectors is very low right now.
So who breaks the tie? Industrials? Where do you look?
In terms of the bellwether, I think you would probably look for industrials. I mean, consumer is still fine. I think what the market is suffering under is a lot of the lopsidedness of the market, right? U.S. outperforming the rest of the world too much tech in the market, nowhere to put it. The market can't handle tech down 2% on the day. And that's what we're seeing right now, even though banks are up. So banks is another area that could be a net beneficiary of this environment.
You had a good discussion on Squawk this morning about rates, and Kramer this morning said Powell needs to change his tone, but the trajectory of rates that we've seen this cycle is not as severe as it had been going into 07, 08.
Not even close. They were raising at every meeting, and they were very transparent about the fact they were going to be raising at every meeting for a couple of years. In fact, that's been one of the criticisms. Personally, you might say Powell needs to change his tone, but the tone he has right now is very purposeful. There's a reason he wanted to put the markets on alert, that they were a little complacent about the possibility of more rate increases. That's my view. So it's not an accident. He doesn't say, wow, I broke something. He says, I successfully added a little bit of risk back into the market.
Right, so you don't think, no rookie mistake in this case?
I don't think so in this instance. I think, it'd be as easy as saying, well, if trade really causes an economic hiccup, we might have to reconsider. Boom. Then you take that risk out of the market's perception.